So where and how would you add those defensive exposure assets?
Hi, good morning. Yeah, primarily through healthcare. When we look across the global landscape and we see inflation continuing to surprise on the upside, and you see a change in terms of market pricing with regard to Fed hawkishness, we have become more cautious in the near term. While overall, we still expect equities to be higher by year end, we still broadly favor stocks to bonds. Do you think it's prudent to add defensive, but primarily healthcare? Healthcare tends to be much more defensive through a weak period of earnings, and as well from a valuation perspective, looks to be one of the more attractive sectors globally.
Here in the U.S., we're almost done with earnings season. More than 70% of S&P 500 companies have reported already, and we continue to hear more warnings about profit margins. What are you seeing across Asia, and is there any sector that you like most or regions?
Yeah, so we are coming down from margins were at historical highs in the pandemic. It's natural for margins to come down, and you are seeing some pressures from input costs from higher inflation. You are seeing some pressures, particularly I'd say in the U.S. from higher interest rates. In terms of regions, we still do prefer developed markets to emerging markets. So we think there's a bit more earnings clarity. There's a bit more growth momentum, say, in the U.S. and Europe. In Asia, we prefer Japan. We see valuations being attractive. We see policy being more stimulative than restrictive. We also see more of an organic domestic recovery as they get through COVID. And so Japan stands out to us for a number of reasons.
Where do you find long-term alpha gains in this market?
From a sector perspective, we have like Japanese banks, as we see banks generally benefiting globally from higher rates. Japanese banks are quite well correlated to higher treasury yields. We also think that domestic recovery, whether it's domestic tourism or domestic consumption, will pick up as well as restrictions are lifted, and this wave right now is quite serious. But as the curve comes down, and from a case count perspective, we should see more of a domestic recovery boosting domestic consumption.
The US-China monetary policy decoupling has been one big investable theme for a lot of investors. Do you still see that sort of stark gap really playing out, and is that really where the opportunity is?
It's one of the key questions, I think, facing markets this year. Just like inflation is really a key question for global markets or for the U.S., I think for China, whether or not monetary policy and even the economic cycle can really decouple from the rest of the world, that's a key question. Historically, that has not necessarily been the case. You wouldn't see massive easing in China when the rest of the world, particularly the Fed, is tightening. And right now, they are on the path towards easing when the rest of the world's tightening. Their cycle looks much different. The policy cycle looks much different. But whether or not they can do that, whether we can see large easing in line with what the economy appears to need, as the Fed is on the path of aggressive hiking cycle, will be, I think, a key determinant of how Chinese markets perform. We think they probably can ease a bit, but we can't see necessarily large easing, large rate cuts, a large injection of liquidity, because there's obviously the risk that some could flow out, the currencies could depreciate. And so that is a key question. We think they can decouple a bit, but not entirely.